the introduction. Welcome to our second episode of the Time Equities Spirit Series. Today we have John Dulberg, Director of Acquisitions at Time Equities, joining us. John and I actually, he sent me his a little introduction piece for him to basically give to the audience here, and I realized that he and I joined Time Equities basically in the same year together. So I've known John now for going on 9 years now, going on 10, and we've of course gotten to know each other's significant others and so on and so forth. So it's been a good friendship and relationship to have over all this time. In Jonathan's role, he focuses on sourcing and executing value-add and opportunistic acquisitions in not only here in the U.S., but also him and his team have been focused over in Europe as well. Today we'll be focusing primarily on our recent Holland strategy, which took effect, correct me if I'm wrong, going back to 2015, 2016. I don't know when you guys actually started poking around over there. But before we get into that, why don't John, you kind of speak to how you found yourself at Time Equities, going back 9 years ago, and doing acquisitions.
Yeah, for sure. So prior to being at Time Equities, I worked at a large institutional fund-of-funds manager that invested in underlying funds that would then go and invest in direct real estate. And so this is 2007, 2008. So we're talking at the sort of precipice of the global financial crisis, and some of the underlying funds that we would invest in had familiar names like Lehman Brothers and Bear Stearns, to name a few. And so, needless to say, there wasn't a lot of activity in the fund-of-funds world, but yet what we saw was that we had a large amount of capital that we had raised, and because of our mandate, we had to sit on the sidelines. Despite the fact that it was clear that there was a tremendous amount of opportunity to invest in direct real estate at the time. After a few years of staying there, I decided to transition and focus more on direct real estate investment, knowing that the closer to the bricks I was, the better chance I would have at actually being a real estate investor. I found Time Equities through a mutual friend of mine at the time who was working at Time Equities. I think what drew me to Time Equities, other than the fact that it was 2011 and I was happy to have a job, was that it was a 40-plus-year-old company that owned hundreds of buildings. But yet, when you got down to the guys that you were working with, they were young and thoughtful and experienced well beyond the years that they've been working in the industry, and that Bob and Francis encouraged us to think creatively and work through complex structures, and be as entrepreneurial as possible in sourcing our opportunities. And so that flexibility really enabled us to be successful coming out of the recession, when there was a tremendous amount of hair on almost every deal that you looked at, and you had to kind of think outside of the box in order to be successful.
Yes, no, I definitely remember that time when I joined there. It was and watching, obviously, as the company progressed out of the global financial crisis in 2011, 2012, and then obviously as it prospered over the course of the next decade, and now we're kind of right back into the downward cycle of it all. But it feels different, obviously, between the two events. All right, so could you just briefly describe exactly the dynamic of the acquisition asset management teams at Time Equities? I know it's different than many other companies out there that may have them set up as different departments, but I think it's from when I describe to not only investors as well as advisors and other partners of ours of how we're set up and how unique it is, people respect it. And I think if you could just go into a little bit of detail in terms of exactly how that works.
Yeah, sure. So you're right, right? It's certainly unique when you compare it to other private real estate companies, especially ones that are our size and have as many assets and do as many deals as we do. So the structure really is that within the acquisitions and asset management departments, there are individual teams, predominantly comprised of 3 or 4 members that are tasked with coming up with specific investment strategies or look towards certain asset classes and then seek to execute transactions based on the themes or the investment thesis that they've come up with. So for instance, I'm on a team that's run by Aaron Medeiros and supported by an analyst. And Aaron and I have been working together for 10 years, so you know, or close to 10 years, 9 years at this point. So he and I have developed a very strong collaborative approach to how we look at deals and how we manage them. And I think that we've got confidence in one another, that we're both able to step in, or, you know, I know that I come with my biases on a lot of deals, or you know, if it's a deal that I'm pushing, you know, he'll sort of, you know, point out the things that are not, you know, clearly in front of me and gaping holes in it. And I try to do the same with him as well. So it's a very good back and forth dynamic that we have, especially working together for nearly a decade. And then, you know, on the asset management side, I think that's even more unique in the sense that that once we acquire assets, we don't just ship them off to an asset management department like a lot of other firms do. So we're in charge with executing the business plan. So in effect, we have the responsibility to take deals from cradle to grave. So we source our own deals, we negotiate purchase and sale agreements. Once we close, we hire leasing and third-party management. We then implement the business plan, whether it's something as mundane as negotiating janitorial service contracts or picking out tile for renovated lobbies, all the way up to negotiating leases for 50, 100,000 square foot tenants. And then finally, when there's, you know, an exit, we negotiate the refinancing, or in very infrequent cases, the sale of the asset. So that's extremely unique, and it does 2 things, probably more, but off the cuff, it does 2 things that are critical. One is that it requires the acquisition guys to take ownership of the numbers, right? So you can't just underwrite 5% rent growth every single year and cap rates that will compress down to 4% on an exit, and you've got a 50% IRR. Go execute the deal, some other guy, I'm setting you up for failure. So we've got ownership of the numbers and of the business plan. And that's critical, right? Our feet are the ones that are held to the fire in terms of how to execute the business plan, and its success based on the underwriting is dependent on how well we underwrote the deal to begin with. And the second thing that it does is it familiarizes us and provides us with an expertise within markets and within specific asset classes. So we are really able to understand how these buildings operate, right? And where you can make mistakes, and what potential pitfalls are, and what you should look out for and what you shouldn't, because we're doing this day in and day out. So when we're underwriting deals, it really allows us to refine our models, our assumptions, and also the markets that we focus on. And then, you know, another part of the team is obviously in the Netherlands, where we have John Chappins, who joined us and runs the acquisitions and the asset management there locally, and has been sort of a very critical part of the growth that we've had there.
Yes, no, I agree. And, you know, like you said, I like the dynamic of how the acquisitions and asset management teams work, because they're almost like little mini time equities, you know, companies in their own, or you're running a business within a business.
Yeah.
And there's a lot of trust amongst various different team members like you and Aaron have, in terms of getting things executed and having them be done right and timely. And ultimately, you know, that goes back to, you know, France's leadership in terms of how he trusts, you know, everyone to run these, you know, various businesses of their own, and the tremendous amount of responsibility that comes with it.
Yeah.
So So switching gears, I know I mentioned earlier that we would kind of focus a little bit on Holland, and I know you know, many people on this call are curious in our international foreign business strategy. So why Holland in the first place? And on top of that, maybe you start with this first. Actually, is when and how do you identify a country as a place to pursue acquisitions to begin with, and then maybe go into then specifically, you know, why Holland?
Okay. So let's say broadly speaking, you know, the strategy that Aaron and I have and try and implement is that we look towards this location as a driver of deal flow. And what that means is that we try and find certain markets in which the fundamentals, for a variety of reasons, have eroded, and there are opportunities to acquire assets at pricing levels that are below where we believe the true value to be. And that could be the result of a lot of factors. You know, there could be too much liquidity or too much debt on assets, or a lot of forced sellers, or a lot of mismanagement of assets. But broadly speaking, those are the narratives that we look for. When evaluating countries, they've got to have, you know, a lot of transparency in terms of their legal structures and the rights that you have. So we've evaluated a lot of countries, and many of them just don't have either tax or legal systems in place that would give you confidence to invest in there, and feel like you were protected in the event that something bad were to happen. So you know, in going back to our transition to Holland, you know, in 2015, like you mentioned, it was pretty clear to us, and I'm sure a lot of other folks, that in the U.S. at least, the market for real estate was sort of back, right? The transaction volume was very high. There was a lot of liquidity in the capital markets, both on the debt and equity side, and pricing was not at levels that we felt comfortable transacting at, and therefore we weren't seeing the opportunities that we had seen in the previous 3 or 4 years. So we had started to focus on a few other markets, and Aaron started looking in Europe and in Spain. And in Spain, the story was that, you know, despite having, you know, high unemployment and a lot of sort of macro issues, there just wasn't pricing that was reflective of everything that was going on. And then either by chance or good fortune, you know, we through a mutual relationship that we had, were provided with an investment opportunity in Holland. And it was one that both of us were scratching our heads on, because it was a single tenant leased building for a 12-year term with a publicly traded company that at the time was asking for, I believe it was a 10 cap. So without any financing, we could buy that building at a 10% return. And to us, that just didn't make sense. The return was disproportionately high relative to the amount of risk that you were taking in that deal. So we actually didn't move forward with that transaction. The timing was very tight, and we were convinced that there was something wrong with it that we weren't figuring out, and we didn't want to be the stupid, you know, Americans that came in and bought the deal that everyone was going to laugh at 3 months later. So we spent the next several months sourcing deals, building a network, going out there and trying to understand sort of operationally and legally and from a tax perspective how everything worked. And what we found was that there was a tremendous amount of debt financing and leverage in the system, that when the global financial crisis set in, was just unserviceable. So, you know, the growth that existed and the development that existed was just unsustainable in a downturn, which led to a lot of loans being underwater. And in addition to that, a lot of the lenders that were previously in the market, whether from Germany or even in the Netherlands, were not willing to lend on assets locally anymore. And the third part of it is that the borrowers or the buyers that were usually in the market, the local guys, were dealing with problems of their own within their portfolios, or they didn't really have the liquidity to buy deals. So we found this to be kind of the perfect storm, where we can buy good risk-adjusted returns, and come in a position where there's not a lot of liquidity, and provide liquidity to the market either through joint venture structure or through direct real estate investment. And so that, really worked out in the sense that it lagged the U.S. In terms of its recovery, but it really followed the same steps that we saw. So it was something that was familiar and foreign at the same time. But once we wrapped our head around it and got comfortable with it, we proceeded to make several investments, and obviously it's grown into what it is today.
Yeah, no, makes sense. And for those of you on this call, a portion of our acquisition pipeline is a combination of it is reliant in some way or another on having a tremendous strategic partners network of brokers and banks and property managers and even other real estate owners that come to us or we go to them. And the partnership, allows us to expand our footprint not only throughout the U.S., but also gain intelligence into other markets that we're unfamiliar with, which is how we found ourselves, investing in Canada back in the 90s, and then going over into Europe, in the early 2000s, Germany, Holland, and so on and so forth. And that will continue to build on itself over the course of time. And, we'll likely have, John or Aaron back on this call, in the next country that we wind up going into in the future, if it is identified. All right. So could you just touch on the current makeup of our existing portfolio in Holland and the business plan that has been implemented over the past 5 years now, and as well as going forward?
Sure. So currently we've got 34 properties in 25 cities that account for about 1.5 million square feet of direct investment. And in addition, we've got another 500,000 on a joint venture basis with partners. It's predominantly office properties, though there's some industrial and logistics in there as well. And our focus really has been to take advantage of the opportunities that we look to take advantage of, based on our strategy, which is, motivated or forced sellers, distressed acquisitions, through over leveraging, et cetera. So as a result of that, the business plan has a similar value add approach to it that it does for a lot of our assets in the U.S. And namely that consists of sort of three main components, right? So after we acquire the asset, we focus on strategic upgrades to the properties, whether it's just basic cosmetic stuff, renovating lobbies, common areas, sprucing up buildings, adding amenities and creative spaces that are in high demand. Then obviously it goes towards managing expenses. And you have to keep in mind that a lot of these buildings were owned and operated for a period of time by either a lender or a private equity company that sort of bought the larger portfolio loans. And so they really did a not so great job, because real estate's not their core business, of managing the expenses within these portfolios. So we're able to come in and really run an effective and lean operation, knowing how to underwrite these deals and how they should operate based on how they were operating before. So that's the second part. The third part is managing a very effective lease up. And I think, to our credit, unlike a lot of other companies, we underwrite deals in a way where we don't seek to over improve the buildings or push rents to levels that are unsustainable based on the markets in order to create some return on a piece of paper that won't come to fruition. In fact, we try to do more thoughtful, deliberate, and specific improvements to areas that we know will have high impact at low costs or relatively low costs, and often seek to undercut rents in these markets given our acquisition basis. And we typically find that when we do those standard sort of ABCs of investments, that in the long run we're successful in implementing our business plans, and that's proven to be true in large part in the U.S. and in the Netherlands as well.
Okay, so we're not everybody can obviously invest overseas here in the U.S. And of course, not everybody has the capability of expanding beyond even their local operations, no matter whether they're a U.S. buyer or they're an international buyer overseas. So what, I guess, competitive advantage does TEI have over other either local Holland operators as well as other international buyers from across the globe?
Sure. So predominantly, we have the ability to close acquisitions all cash and worry about the financing later, which is a huge benefit to dealing with these sorts of transactions in these types of markets when liquidity is not something that is easily attainable. So we focus more on mid-market opportunities in secondary markets because the yields and the pricing they're going in is sort of reflective of where we see a lot of good value. And in those markets, the buyers don't necessarily have access to the same capital that we do and aren't able to close all cash. And so from a what can you offer to the seller perspective, if all they care about is surety to close, we give them that. And that's critical in building your name and your reputation within a market, because a lot of other groups would come in and try to tie a deal up, go and raise the money, not be able to raise the money, ask for a price reduction, ask for a financing contingency at some later date. And so you saw, and what we heard initially is that a lot of the deals that we were looking at, right, were just mired by 3 or 4, false starts in the market. And it was all the same groups. And it was a legitimate liquidity crisis, with debt not being available for these types of products. So we gave them a surety to close, and we still do now that we've built up a strong reputation. So that's first and foremost. And now that we've got a team there locally, we've got sort of boots on the ground and the expertise to source transactions that other people may not see. So if there are other international buyers, they may not have an operation locally. They may rely on sort of third-party everything, management, leasing, et cetera. Whereas we have, boots on the ground that day in and day out are looking for opportunities and are very deeply entrenched within that market. And then, the other side of it is that one benefit is as we've seen, when liquidity comes back, and so we lose that, we lose some amount of that competitive advantage for buying things all cash. We gain in the sense that that returns and cap rates are compressed because there are other groups that can now invest in the market. So it's worked on both sides, both initially and currently. Now that there's a bit more liquidity in the market, or at least there was, pre-COVID.
Okay, that makes complete sense. And even over here, in the U.S., I've heard plenty of stories where we're typically, not the highest bidder in an acquisition scenario, and yet we still are brought the deal and are awarded the deal due to the reputation that we have in the submarkets that we own properties in.
Yeah.
So coming now most recently and current, we'll touch on a little bit of COVID. So how has COVID disrupted Holland and maybe even the other markets that you're looking at in Europe? And has that had any impact on our portfolio to date so far?
Given the partial closures, full closures, and sort of severe restrictions on a lot of these, cities, countries, states, and the U.S. as well. It's had quite an impact, as you can imagine. Specifically in Holland, our portfolio is comprised of primarily office buildings, which through April, have seen a high level of collections, or a level of collections that we were, I don't want to say surprised by, but that was sort of a positive indication to us. I mean, going forward, it's hard to tell exactly how this is going to play out, but we're keeping a very close eye on May and June and July collections, and also working with specific tenants that ask for rent relief in our various portfolios here and in the Netherlands. And then operationally, the focus now kind of turns to the reopening and how we manage that successfully. And so that's done, based on daily collaboration with our teams locally, whether it's third-party managers or leasing, to try and make it as successful as possible, both in implementing social distancing guidelines that might exist in that area, and also creating a level of comfort and safety for our tenants to come back to work, knowing that we're doing everything that we can to put their best interests as a top priority, whether it's by adding day porters to buildings, cleaning high touch areas multiple times, wayfinding within buildings, limiting traffic within elevators, common areas, et cetera. There's going to be a gradual process as people go back to work of getting these buildings back to a more normal state of operations. So I think that story is still being written, but we're working on that as a top priority right now.
Yeah, it sounds very similar to what we will be experiencing here in the U.S. too. So so this is a true global pandemic, and everyone's reacting to it and dealing with it in a very similar way. So John, thank you again for joining us this afternoon or morning, depending on where you are in the country. I know everyone here really appreciated everything that you're able to share. And before we wrap things up, I'll leave you with one final question before we get into the Q&A session. But how are you evaluating current investment opportunities, whether they be here in the U.S. Or over in Europe? And has the investment strategy for you and your team changed on a going forward basis?
So yeah, Aaron and I talk 20 times a day probably, and we're constantly trying to think through certain deals and put our heads together to figure out where there might be value long term. I think what we're seeing right now is that traditional marketing of real estate is sort of dried up, right? No one is sending out blasts with investment memorandums, to buy office buildings, multifamily buildings, retail, et cetera, because there are specific impediments that exist to moving forward with those transactions. Specifically that you can't tour the buildings, but also that there's a large inability to figure out where the capital markets are in terms of valuing these assets. So there's a fair amount of price discovery going on. What we're doing in addition to that is we're reaching out to our networks daily, right? So whether it's lenders, operators, developers, investment sales brokers, leasing brokers on the tenant rep or agency rep side, we're talking to those groups daily and figuring out what they're seeing in the market, and trying to utilize them as best as possible to build a case for doing something or doing nothing for the time being. I think that there's a bit of distress that's already trickling out in certain asset classes, but primarily it's trading at levels that we don't feel accurately reflect what a post sort of COVID economy might look like. but still we're tracking those to see whether and where they're trading. I think going forward, Aaron and I are going to use the same strategy that sort of served us for 9 years already, and that we discussed and sort of went through before. And what we talk about a lot is that leading up to COVID and before it happened, there was a lot of late cycle activity that was going on with buyers, and what you saw was sort of looser underwriting. What you saw was looser lending standards from a lot of the non-traditional bank lenders. You saw guys that or companies that operationally had no expertise, but yet were taking on significant value add type deals at completely asymmetric risk return profiles, and just pricing that just got to levels that we were having trouble rationalizing, no matter how low interest rates were. So we're keeping track of a lot of those types of opportunities as they mature on the debt side, or as specific borrowers may need to be recapitalized and work through some sort of workout. But broadly speaking, I think right now we're just kind of waiting to see what happens once the economy opens, and figuring out where pricing is as best we can, so that we can make a determination going forward.
Okay. All right. Well, thank you for that. All right. So what I'll do is I will open up. Well, I'm not going to unmute everybody, but if you do have questions, please enter them in the chat box here, which I can take a look at. And John, I will fire a couple of questions at you that have already come in, and you can keep them, short, quick answers, because I know you didn't have a chance to prepare for these. But and some of them are opinionated too. So I guess you can just answer as you may. How will Europe's real estate market bounce back from COVID in comparison to the U.S.? Do you have any thoughts on that? Or will it be the same, different?
That's a tough one. The answer is that I don't know the answer quite yet, and I think that it'll certainly play out in the near term. I think that the U.S. will have challenges coming out of it, just given that each state had varying degrees of severity with it, and sort of there wasn't a holistic approach to a shutdown, whereas other countries, may have had that, and been spared to some degree from how bad it could have been. I think a lot of it will rely on whether or not the capital markets, are there in Europe. They certainly aren't really there in the U.S. right now. So, I'm not sure. I think if we're on here in 3 months, I'd be happy to answer that question.
Yeah, and I guess that to dovetail off of that answer, when as it relates to buying opportunities here in Europe or the U.S., it's still probably a little too early to know how those will result and surface over the course of the next 6 to 8 months or whatnot. All right, here. Next question. Will office demand be reduced coming out of COVID? What are your thoughts on that?
Perhaps. I've been talking to a lot of tenant rep brokers who have sort of varying degrees of answers based on how many tenants I think they represent. It'll certainly change. Tenants will certainly in the near term look to potentially reconfigure their space to have it be in line with more acceptable social distancing guidelines. And we've seen that already with some of the deals that we're working on through COVID, as tenants build out their space and change their floor plans or their footprints to be more mindful of the fact that there are these requirements to be 6 feet away and not pile as densely as possible, people one on top of the other. So I think that there will be modifications to certain companies and how they utilize floor plans, and perhaps the open floor plan may not be as popular as it was in the past. but again, I think it's also a bit too early to say. I'm more looking towards, what companies sort of will come out of this, and how they'll view, how their staff will view the experience of working from home. I think a lot of companies, may find that their employees were not as successful working from home as perhaps they thought, even if on a corporate level, they thought that it was a fantastic experiment in work from home. So I think it'll depend. There'll certainly be less of a demand for office space, and tenants will look to reconfigure their space to be more in line with certain guidelines. But I'm hopeful that there won't be a seismic type of watershed change in how office space is utilized.
Okay. All right. Well, I'll wrap it up for today. We've gone a little bit over the 30-minute mark, and I want to be sensitive to it's time here that joined us. So thanks again, John, for everything today and your time. For those of you on the call, as I mentioned on Monday, we're going to be doing this series throughout the course of May at 1 o'clock every Monday and Tuesday. And next week we have Elena, who runs our sustainability department, joining us. So she'll have a presentation prepared to speak about her role in time equities, as well as how sustainability is factoring into COVID and our going forward strategy. And then on Wednesday we'll be having another one of our acquisition specialists join us. His name is Max Pastor, speaking about everything that he's been working on too, back here in the U.S. So with that, I'll leave you guys. I will, for anyone that wants to follow up with myself or John after this, my phone number is, and you can take it down, it's 212-206-6176. And then my email address is and then my last name, Anderson, Anderson, @timeequities.com. John, why don't you share your contact information as well, and then we'll wrap it up.
Yeah, sure. So for anyone that has any questions or any thoughts, feel free to email me at jdulberg, DULBERG, @timeequities.com.
Great. All right. Well, thank you again, and we'll wrap this up.
Thanks,
John.
That was great. Thank you.